These are my 5 biggest financial mistakes that I made in my 20s. Please learn from my failures so you don't repeat the same ones, and pay special attention to the last one, which is the biggest financial mistake that I've made so far. Financial mistake number 1, having money sat in my bank account. Partly because I had no idea how much I was spending this month. As I didn't have that reset at the end of each month where the bank balance went to £0 or £1,000, this meant that I didn't really know if I was spending £500 over budget or £300 under budget. It also meant that because all of this money was kept in just one account, I didn't really have any goals or intentions of what I wanted this money to go towards. So I wasn't intentionally saving for a holiday, or I wasn't intentionally saving for buying a house or investing for something in the future. It was just sat in one account with no purpose. And one of the other issues of having money sat in the primary account means that it's not really earning any interest. And this meant that the money was losing value versus inflation. So each year the price of goods gets a little bit more expensive, and my money wasn't growing to be able to keep up with this increase in cost of living. What I'd do instead is I'd open a high yield savings account, which has a higher interest rate, currently around 3 to 5%. And I would keep my money in there. This means that it would be separate from my spending account, so I would be able to take note of how much I'm spending each month. And it also means it's earning interest every single year, and it has a set purpose. So if I had a high yield savings account for an emergency fund, I could also have another savings account for a holiday or saving for something within the next 3 to 5 years. My financial mistake number 2 was not investing sooner. And this is quite a big financial mistake that a lot of people make. So I didn't actually start investing until around April 2020. And I'd been earning for about a year and a half before I even considered investing or really understood what it was. Now, that's not too bad in itself, but I only really considered investing because we had the lockdown and I had that spare time and I could see the money that was sat in my account. But if we hadn't had the lockdown, I don't know how many years it would have taken me to actually think that I should be investing my money and growing it. Financial mistake number 3 was spending on things that I didn't value. So I've worked in the luxury fashion industry for the past 5 years, and this has definitely really heavily influenced me and my purchasing decisions. I spent my work days surrounded by luxury items and analysing the performance of these very high price items on the website. So this meant that I ended up spending a lot more on fashion and clothes than I ordinarily would, and also meant that it completely warped my price sensitivity. So all of a sudden I was regularly seeing £300 tops on the website. So this was something that I became familiarised with. It also meant that the people I was surrounded by in my work day to day were also spending a lot more on fashion. So this just became the norm. And the other thing that I spent on that I didn't truly value was going out. So I've definitely realised I'm much more of a daytime person. I really like getting up and going to explore different parts of London or doing day trips on my weekends. Whereas previously my social life was much more focused around the evenings, where I'd be going to parties or going out for drinks with friends. And that just wasn't really in line with how I liked spending my time. So now I've understood that, I can make sure that I'm planning my time to do things in the daytime and going out for lunches and going to explore new areas, rather than waiting for the whole day for an evening to then go to a party or go out for drinks. Financial mistake number 4 was holding investments in one single company. Now, whenever investing is talked about, you always hear the word diversification. And what this means is investing in multiple different companies across multiple industries. This means that you don't have all of your money put in one small area, which would increase your risk. So instead, you're spreading out your risk across a lot of different companies in a lot of industries of a lot of different sizes. Now, the mistake that I made was having a decent chunk of money saved in just one company, which meant that I had a higher risk and a much higher dependency on the performance of that company. Now, I was working at a tech company, and what they typically do for an annual bonus is they would give employees shares in the company rather than giving them a bonus in terms of money. And whilst the company was doing well, this was absolutely fine. But when the performance of the company started to tumble, this is when the value of the shares also started to degrade. And one of the main reasons why it's suggested that employees should cash in their employee shares earlier is because you already have your salary dependent on the company. And then if you add in shares, which could be quite a large amount of value, you're putting an awful lot of risk and trust into this one company. And if the performance of the company decreases a lot, this also means that the company might start looking into redundancies. So all of a sudden, your shares would have decreased in value, and also your job may be less secure and have a higher chance of redundancy. So what I wish I'd done is I wish I'd removed those shares from the company as soon as I could, and then reinvested them in a index fund, which is a lot lower risk and is completely separate from that company, which means I don't have multiple dependencies. And my biggest financial mistake, not negotiating my salary. So like most people, I felt like I had to be grateful for what I received. So each year I would get a slight increase on top of the salary that I got the previous year, and I would just accept this and be happy and move on without actually thinking to check how much I should be paid and whether I should be asking for something higher. When I finally did the research, I realised I was being underpaid by about £8,000 versus the industry rate for the role that I was in London. Now, the issue of being underpaid currently means that it really impacts your ability to earn in the future. So usually people base their salary increases off the current salary that they have now. So if you're going for a new job, you'd think, oh, maybe I want a 20% higher salary than what I have now. And if you're already being underpaid, this means you're likely selling yourself short. Whereas if you had a fair market rate salary now, then you would be asking for even more when you go for that new role. And one of the less commonly talked about issues with being underpaid is how it can affect you emotionally and mentally. So this can really impact your self-worth and make you feel undervalued in the job that you're doing, or that you're not performing well enough. And this just isn't the case. Typically, a lot of companies will try and pay the least amount possible because that is the cheapest way for them to run their operations. So you need to be your biggest advocate and ask for that increase in pay or that salary that you deserve. And it could just be a case of a couple of short conversations that are the difference between you earning what you are earning now or you earning £5,000 or £10,000 more. So it's definitely worth doing. Now, if you want a video on how to negotiate your salary and get paid your worth, check out this video here. And please don't repeat the same mistakes that I've made. The biggest ones to pay attention to are definitely investing early and negotiating your salary. So check out this video if you'd like to learn how to negotiate your salary successfully.